You saved your whole life, 3 accounts, maybe 4, all sitting there ready to go. And the day you retire, most people, they just start pulling from whatever feels right, usually whatever's biggest or easiest to get to. That's the mistake, because the order you pull from those accounts, it isn't a small detail. It's one of the biggest tax decisions you'll make in retirement, and almost nobody talks about it before it's too late. By the end of this video, you'll know what 3 buckets, why sequence matters more than the balance, and how pulling from the wrong one first can quietly hand tens of thousands of dollars to the IRS that you never had to give them. I'm Mike Dunlop, a CFP, an Air Force veteran, and founder of Ignite Financial in Cedar Falls, Iowa. We built the firm flat fee and fee only on purpose. That means no commission, no percentage of your nest egg, no sales pitch. I was trained as an accountant, so I'm conservative with the numbers and a little bit obsessed with not leaving Uncle Sam a tip. Mostly, I've got the heart of a teacher. If you don't understand what we're doing, I haven't done my job. So let's get into it. Order matters more than the balance. Most people heading into retirement have spent decades thinking about one number: the balance. How much do I have? Is it enough? And that's a fair question. But the moment you flip from saving to spending, a second number becomes just as important: how much of that balance you actually get to keep after tax. Think about it this way. 2 neighbors. They retire on the same day, same amount saved, same Social Security check, same spending need. One of them pulls from her accounts in the wrong order and ends up paying 22 cents of tax on every dollar she spends for the next 20 years. The other one is thoughtful about the sequence, and she's paying 12 cents on most of it. Same balance, same lifestyle, tens of thousands of dollars in difference just from the order. And that's what we're talking about here. Not exotic strategies, not loopholes, just the sequence. And the reason that this works, it comes down to how differently the IRS treats different types of accounts. Not all retirement dollars are created equal. Some have already been taxed. Some haven't been touched yet. And some grow and come out completely free of tax. The bucket that each dollar sits in, it determines how it gets taxed when you spend it. And that is the whole game. Before we walk through the order, we need to name the 3 buckets clearly, because it's one of the things that if the foundation is fuzzy, the rest of the plan doesn't really land. Number 2, the 3 buckets, what they are and how the IRS treats each one. Bucket 1 is your taxable brokerage account. This is money you've already paid income tax on. You earned it. You paid taxes on it, and then invested it in a regular brokerage account. The IRS has already taken their cut on the principal. When you sell something in here and it's grown, you owe capital gains tax on the growth. But here's the key. If you've held it for more than a year, it's taxed at long-term capital gains rates, which are a lot lower than ordinary income rate. For a married couple filing jointly in 2026, if your taxable income is under $98,900, your long-term capital gains rate is 0%. That's a real number, 0. So, in the right circumstances, you can pull from a taxable account and owe nothing on the gains. Bucket 2 is your pre-tax account. This is your traditional 401k, your traditional IRA, your SEP IRA if you're self-employed. The money went in before taxes. It grew tax deferred, and the IRS has been waiting patiently for you to take it out. When you do, every dollar comes out at ordinary income. It stacks right on top of your Social Security, your pension, everything else. And once you hit RMD age, which is 73 if you were born between 1951 and 59, you don't get to decide anymore. The IRS tells you how much you have to pull out. Miss an RMD, that's a 25% penalty of the amount you should have taken. So this bucket has a timer on it, and that timer changes your strategy. Bucket 3 is your Roth. Roth IRA, Roth 401k. You put the money in after taxes, it grew tax-free, and qualified withdrawals come out completely free. No income tax. And a Roth IRA has no required minimum distributions for the original owner during their lifetime. That makes it the most flexible, most tax-efficient dollar in your whole plan. And it's also the most valuable one to protect, because it's the only bucket where future growth is permanently sheltered from the IRS. Those are the 3: taxable brokerage, pre-tax accounts, and Roth. And the order that you draw them down changes your tax bill every single year. Account 1, start with your taxable brokerage. The conventional wisdom on withdrawal orders says to pull from taxable first. And on this one, I agree with the conventional wisdom with one important nuance. The reason to go here first is that capital gains rates, especially at lower income levels, they're genuinely favorable. In 2026, a married couple with taxable income under $98,900 pays 0% on long-term gains. So, if your spending needs are covered and your other income is modest in those early retirement years, you could be selling appreciated investments and paying nothing on the gains. That's not a trick. That's just using the tax code the way it was written. Now, there's a nuance. Not everything in a taxable account is treated the same. If you've got positions that have been held a long time and are sitting on big gains, those are the ones to pull from first because they get the preferred rate. If you've got something that's down, you might sell it and harvest the loss and use that to offset gains elsewhere. And if you've got bonds or other interest-paying investments in there, the interest comes out as ordinary income, not capital gains, so the math is different. Picture a hypothetical couple, and we'll call them Jim and Carol. They're both 63, just retired, living in Iowa. They've got a taxable brokerage account with about $280,000 in it, made up mostly of index funds that they've had since their mid-40s. Their Social Security hasn't started yet. Their only income right now is a small pension of $18,000 a year, and they need $60,000 to cover their spending. So they pull $42,000 from the brokerage to fill that gap. Their taxable income after the standard deduction, which for a married couple in 26 is $32,200, it sits right around $27,800. Their long-term capital gains on the brokerage withdrawal, 0%. They covered their spending and paid nothing on the growth. That's what early retirement can look like if you sequence this right. The window for this is real, but it's not permanent. Once Social Security starts, once RMDs kick in, the income stacks up and that 0% capital gains window, it narrows. So use it while you have it. Account 2, the pre-tax accounts managed carefully. And so we get to the pre-tax bucket. This is where most people have the most money, and it's the one that causes the most tax grief if it's not managed thoughtfully. The money in your traditional IRA or 401k hasn't been taxed yet. Every dollar you pull out becomes ordinary income. That's fine. That's the deal you made when you put it in. The question is how much you pull out each year, whether you decide or you let the IRS decide for you. If you wait until RMDs force you to pull the money out starting at age 73, a large pre-tax balance can push you into a higher bracket than you need to be in. It can cause more of your Social Security to become taxable. Up to 85% of your Social Security benefit can be taxed when your combined income crosses $44,000 for a married couple filing jointly. And it can trigger Medicare IRMA surcharges, which are extra charges on your Medicare premiums based on the income from 2 years prior. In 2026, IRMA kicks in for single filers with income above $109,000 and married couples over $218,000. Miss those thresholds by $1 and you're paying hundreds more per person per year for the same coverage. So, the strategy with the pre-tax bucket is to draw it down deliberately in the years before RMDs hit, specifically to fill up your lower tax brackets without crossing into the next one. If your income is sitting at the low end of the 12% bracket, you pull enough to use up the rest of that bracket. You're paying 12% on those dollars intentionally because the alternative is paying 22% on them later when RMDs pile up on top of Social Security. I see this pattern constantly when we sit down with people for the first time. They've got $800,000, $1.2 million in a pre-tax account. And they've been told their whole working life to max it out and let it grow. And they did exactly that. Nobody told them the other half of the story though. After you stop working, there's a window to diffuse that. And that window closes when you're not looking. I'm not saying drain it. I'm not saying convert everything to Roth tomorrow. The right amount depends on your actual numbers, your bracket, your other income, your spending, all of it. But the concept is this. You've got some years where your income is lower than will ever be again. Those are your cheapest tax years. Use them. Now, before we keep going, I'm genuinely curious where you're at with all this. Drop in the comments whether you've got most of your savings sitting in pre-tax accounts, in Roth, or a mix. I find this audience is all over the map, and it changes the conversation significantly. The hidden tax tripwire most people hit. The pre-tax bucket is where the sequencing conversation starts to get complicated because it doesn't exist in isolation. Every dollar you pull from a traditional IRA or 401k interacts with other income in ways that create what I call the tax cascade effect. Social Security is the big one. A lot of people assume that their Social Security check is tax-free. For some folks, especially lower income retirees, it mostly is. But once your combined income, which the IRS defines as your adjusted gross income plus half of your Social Security benefit, crosses $32,000 for a married couple, up to 50% of your benefit starts getting taxed. Cross $44,000 and up to 85% is taxable. And pulling from that pre-tax account is what usually trips the wire. Let's take Jim and Carol again. Fast forward to age 73. Social Security has started. Jim gets $28,000 a year in benefits and Carol gets $18,000. The pension is still paying $18,000. Now they hit RMD age and they're required to pull $52,000 from their traditional IRA. Their combined income just crossed $116,000 before they spent a dollar on anything discretionary. About 85% of their Social Security is now taxable income. And depending on how the numbers land, they may have just crossed into the IRMA threshold, which means that their Medicare Part B premiums are going up based on what they're required by law to take out. Now, that's not a disaster, but it is a much more expensive retirement than it needed to be. And the version of this story where they used the years between 63 and 73 to convert chunks of that traditional IRA into Roth, paying 12% on those dollars on purpose, that version has a significantly lower required distributions, significantly lower Medicare premiums, and a lot more flexibility. The tax cascade isn't inevitable. It's a sequencing problem with a sequencing solution. The Roth is the most valuable bucket you have. And the whole point of the sequence is to leave it alone as long as possible. Qualified Roth withdrawals, they're tax-free. They don't count as income. They don't affect how much of your Social Security gets taxed. They don't push you into higher Medicare premium bracket. They don't trigger IRMA. And a Roth IRA has no lifetime required minimum distribution for the original owner. It just keeps growing, tax-free for as long as you live. And that's why the conventional order puts Roth last. And it's why I agree with that default. Every year that the money sits in a Roth growing tax-free is a year you don't have to pay a dollar of tax on those gains. If you've got enough in taxable accounts and pre-tax accounts to cover your spending in the early and middle years of your retirement, leave that Roth alone. When does Roth become the right account to pull from early? And there's a couple situations here. One, you've had a big income year from something outside of your plan. Maybe you sold a property or had some kind of windfall and you don't want to add pre-tax withdrawals on top of an already elevated tax year. In that case, Roth fills the gap without pushing you further into a higher tax bracket. Two, you're right at the IRMA line and an extra dollar of income is going to trigger that surcharge. Pulling from the Roth doesn't count toward that IRMA calculation. Three, you just need cash and literally every other option would cost you more in taxes. In that case, the Roth is there for you. And for the folks who are still working and don't have a Roth yet, it's not too late to build one. If you've got room in a lower tax bracket right now, a Roth conversion is essentially paying tax on those dollars at today's rate so they never get taxed again. Given the trajectory of the federal debt and the general direction of our tax policy, paying a known low rate today versus an unknown rate in 20 years, it's a reasonable bet. And I'm not making a political statement there. I'm just making a math statement. The sequence that I've laid out, taxable first, then pre-tax, then Roth, it's the right starting point. It's not a rigid law. And this is where a lot of people get into trouble because they hear the default rule and apply it mechanically without running their own numbers. There are years where pulling from pre-tax before you drain the taxable account maybe makes sense. If you're sitting in the 12% bracket and there's room to convert some of the traditional IRA to Roth without crossing into 22%, do it. Pay the 12% now. Let that money grow tax-free for the rest of your life. There are years where pulling from a Roth earlier makes sense, specifically to keep your income below the IRMA threshold or avoid pushing 85% of your Social Security into taxable territory. The point isn't to follow the sequence like a script. The point is to understand why the sequence exists so you can bend it intelligently when the math calls for it. What the best retirement withdrawal plan really is, it's a living document that you would revisit every year as your income changes, as RMDs change, as Medicare premiums change, as tax law changes, all of that. Now, I know what some of you are probably thinking, Mike, this sounds like a whole lot of moving parts. And honestly, you're right, it is. And this is one of those things where a sit down with someone who actually runs the numbers makes a real difference. Not because the concepts are beyond you, they're not. You just watch me explain them. But because the interaction between Social Security, RMDs, capital gains brackets, IRMA, and your specific account balances, it's hard to optimize in your head. A spreadsheet can help, but a plan helps a lot more. Now, to be clear, I'm not saying you need someone to hold your hand forever. A lot of people come through our door, they get a plan, they understand it, and execute it themselves from there. Our job is to make sure you understand it well enough to make a good decision, not to make the decision for you. A complete picture, what this looks like in practice. Let's pull it all together with one more scenario before we wrap up. Imagine a hypothetical couple. I'll call Dave and Linda, both 65, just retired. They have $120,000 in a taxable brokerage account, $740,000 in a traditional IRAs combined, and $180,000 in a Roth IRA. Dave's Social Security is $26,400 a year. Linda's will be $14,400. They're not claiming Social Security yet. They're planning to wait till 67 for Dave and 66 for Linda to get a little bit more of that delay benefit. They need $72,000 a year to cover their spending. Year 1 and 2 of retirement, before Social Security starts, they've got almost no income except a small amount of interest. They pull $72,000 from the taxable account to cover spending. Their taxable income is very low. Long-term capital gains rate is 0%. And they also do $30,000 in Roth conversions, pulling from the traditional IRA and converting it to Roth while they're in the 12% bracket. They pay tax on those conversions now at a low rate to shrink the traditional IRA before the RMDs hit. Once Social Security starts, they're pulling from both taxable and a modest amount from the traditional IRA, still staying below the threshold that would make 85% of their benefit taxable. The Roth sits untouched. By the time they hit 73 and RMD start, their traditional IRA balance is meaningfully smaller than it would have been. Their required distributions are low. They're not getting pushed into a higher bracket by a number a spreadsheet may have calculated for them 8 years ago. And the Roth has grown tax-free through all of it. Same savings as a different version of Dave and Linda who just pulled from the big pre-tax account every year because it was the easiest thing to do. Different tax bill, significantly different. A retirement account isn't just an account. It's a tax event waiting to happen. And the question is whether you decide when and how it happens or whether the IRS makes that call for you. So these are the 3 buckets and the order. Taxable brokerage first to take advantage of lower capital gains rates. Pre-tax accounts second with a thoughtful eye on the brackets and the cascade effects on Social Security and Medicare. And Roth last, protected and growing tax-free for as long as possible. The sequence isn't complicated once you see it. Executing it well year after year with all the moving parts interacting, that's where having a real plan matters. If you're within 10 years of retirement and want to actually run your numbers, that's exactly what we do at Ignite Financial. No commission, no percentage off the top, just flat fee planning built around your situation. You can book a free intro meeting through the link in the description. Don't just retire, ignite your retirement. Take care, guys.